Hello and welcome to Crossing the 49th, the Cross-Border Tax and Financial Planning Podcast. I'm your host, Phil Hogan from Beacon Hill Wealth Management, and today we're going to talk about why it's a bad idea to transfer your US IRA to your Canadian RRSP. So today we'll do this with a presentation that I've prepared. So let's start here. Okay, why it's a bad idea to transfer your US IRA to a Canadian RRSP. So we'll work through why, in most cases, this is likely not the best option for clients. We get this question all the time, and we also help clients with moving US IRAs up to Canada all the time as well. So just a quick overview. What's an IRA? What's an RRSP? You can read through kind of the technical definitions of both accounts, but essentially US IRAs and RRSPs are fairly similar in that they're tax-deferred plans. And in most cases, you get a deduction for your contribution into the plan. And when you withdraw from the plan, you're taxed on that distribution. I mean, that's a very general overview of IRAs and RRSPs, but in most cases, deduction on the way in, and you are taxed on your withdrawals from the plan. So the idea is it incentivizes you to save and invest while you're younger. And when you're older and you reach a certain age, those accounts will be required to be distributed from. Okay, so let's talk about why would you want to move your US IRA? So in a lot of cases, you're moving up to Canada from the US permanently. In a lot of cases, it doesn't make sense to keep that IRA in the US, especially if you have other Canadian investable assets and you want everything kind of managed in one place. And the other reason might be you're only Canadian, you really don't have ties to the US, and you might have inherited a US IRA, or you would work down there for some period of time and accumulated a US IRA, and there's no real reason to leave it down in the US. You might be consolidating accounts. Once again, makes it a lot simpler if everything's in one place. And once again, just simplicity. You don't want to have a bunch of accounts scattered all over the place, especially if you have cross-border tax returns to do. That can be really tricky and unnecessarily complex and unnecessarily costly as well. Okay. Now, question we get all the time, can Canadians own IRAs? Yes, of course. There's no reason why a Canadian, even though if that Canadian's not also a US citizen, they might have once again moved down to the US, worked for a little bit, accumulated an IRA, or they might have just inherited an IRA. So there's nothing precluding Canadians from owning IRAs. Now, of course, there's a bunch of rules around how to hold these accounts and what level of tax you pay on distributions. There's a difference between you're a US citizen, you actually file US returns, versus a non-resident of the US, and you might receive distributions, and there'll be a specific amount of withholding tax. But yes, Canadians can own US IRAs. Okay, now very generally here, how do IRAs work from a Canadian perspective? So from a Canadian tax perspective, even though they're US-based accounts, they're protected under the treaty in the sense that they're deferred for US tax purposes until you withdraw the funds, and they will be deferred for Canadian purposes as well under the treaty, as long as the funds remain in the account. The IRAs are relatively straightforward from a Canadian perspective, unlike some other accounts like Roth IRAs or even taxable investment accounts in the US. So no formal Canadian tax disclosures. I mean, you have to report income and the distributions of income, but there's no reporting of the account, especially on forms like T1135. So on T1135s, you have to report your foreign assets to the Canadian government to the extent that you have $100,000 in costs in those assets. The IRAs are specifically excluded from those rules. So it makes owning or holding IRAs as a Canadian relatively straightforward. The distributions are fully taxable once you receive the distributions in most cases. You're going to convert, for Canadian purposes, you're going to convert the US IRA payments at the average rate for the years in most cases. In some cases, if you have lump sum distributions, you might do it at that particular time. But if you're getting regular distributions, they tend to be at the average rate. And there'll be a 15% withholding tax on distributions for non-residents of the US, which would then be your foreign tax credit in Canada. For Americans, it would be a little bit different in the sense that you're taxing those distributions on a US tax return. So whatever taxes you pay on your US tax return will be your foreign tax credit on your Canadian return. And once again, to a maximum of 15%, because under the treaty, you can only get a maximum 15% tax credit on your Canadian return, or rather, you should only have to pay 15% tax to the U.S. under the treaty. From a U.S. perspective, which is likely less relevant, when you're contributing, because that has already happened. So you get your deduction upon contributions in most cases. Distributions are fully taxable in most cases with treaty limitations. In some cases, there might be some cost basis that is not taxable to you on your U.S. return. And then once again, 15% distributions to non-residents of the U.S. under the treaty. So that would be if you weren't a U.S. citizen or a green card holder and you withdrew, let's say $10,000 from your US IRA, you would have a 15% tax that went to the IRS, and that would be your final tax, and you wouldn't have to file a tax return. And we actually see this a lot, where if an incorrect withholding is done on a US IRA for non-resident of the US, you'd have to correct that by filing a 1040-NR form. So if they withheld 30% incorrectly, it should have been 15. You would file a return to recover and get a refund of the difference. If they didn't withhold anything or less than 15, then you'd have to file a 1040-NR in order to pay that difference, essentially. That gets missed a lot. We see that a lot. Okay, now today we're going to talk about why it's not a great idea to transfer your US IRA to an RSP. However, in some cases, it can make sense. So in what cases would you want to transfer your US IRA to an RSP? Now, we're going to walk through the calculations of this in a couple slides. But in some cases, if the account's relatively small, you have a $20,000, $30,000, IRA, maybe it just makes sense just to transfer into your RSP, and we'll talk about how that can work later. Might not make sense just have it fully managed if it's a small account. In some cases, and we aren't going to get too deep into the complexities and details of income splitting, but one of the reasons you might want to transfer your US IRA to your Canadian RRSP is the IRA, or the US IRA, is not eligible for income splitting for Canadian purposes. So there's certain amounts of income, mainly pension income and RRIF income, that you can split with your spouse. IRA income is not splittable. So if you took that US IRA and you transferred it to an RRSP, and then eventually at the age of 71, that RRSP converts into a registered retirement income fund, and you receive a distribution from that RRIF, then that would be splittable with your spouse. So that's one way to have the IRA income that would not be splittable in the future become splittable with your spouse. So that might be one reason why you might want to do it. In a lot of cases, that income's already, there's enough income to be split, and there's a max on those splits anyways, but that might be something to consider. And the last reason might be just you have no other options. For some reason, you can't find a cross-border investment firm to help, and then you might just transfer that amount to your RSP. But we're going to talk about how that can be quite challenging in certain situations depending on the size of the IRA. Okay, so what are some of the challenges with trying to transfer these US plans to Canadian RRSPs? For large accounts, and we'll walk through the calculations here in a little bit, for large accounts, it could take many years. So you're only really able to transfer an amount equal to roughly to the amount of your Canadian source income. So if you had a $50,000 IRA and you had $50,000 of Canadian source income, you can likely transfer that in a year or two. If you had a $500,000 US IRA and only $50,000 in Canadian source income, it would take you about 10 years to transfer that in. So that's a lot of work. I mean, the expense of filing, the IRA will remain open that whole time as you're, withdrawing funds from it, transferring it to the Canadian RRSP. The calculations have to be done every single year. You need a fairly competent cross-border account to help with that, because you'll need that on an annual basis. Not only that, Canadian foreign tax credits tend to get reviewed all the time. So you might have to deal with CRA on that transfer every single year. It can be a big pain. Of course, the Canadian CPA that's helping would have to charge you for that correspondence with CRA if you're not doing it yourself. So that's a big challenge. And of course, US inherited IRAs do not qualify to be transferred in to an RRSP. So if you're talking about a US IRA, you're not going to be able to transfer that in regardless. So those are some challenges in getting the account into Canadian RRSP. So we're going to walk through two examples, one being transferring in a $50,000 IRA to an RRSP. And that would be, on the smaller side, when we talked about, that might be something that you would want to do. It'd be probably tough to find somebody to manage a $50,000 account. And then we're going to talk about what it looks like to do a $500,000 account. So let's just go we'll go right into the spreadsheet here. Okay, so the way I built this, we're considering a $50,000 and this is all in let's just say one currency, just to make it easier so we're not going back and forth. But let's say this is in Canadian dollars. So $50,000 IRA, and once again, very general discussion here, the calculations can get quite complex, but you have $50,000 you want to transfer from your US IRA that's not inherited to your Canadian RRSP. So in this example, you have $50,000 of Canadian source income. You have the $50,000 of IRA transfer, which is income because it's getting distributed out from the account, so it'll be taxable. Total income of $100,000. Let's assume your Canadian tax rate is 20%. This is how the foreign tax credit would be calculated. So essentially, you take your IRA income, your foreign income, $50,000 over a total of $100,000 of income. And essentially, the tax that you're going to pay is going to be the lesser of the Canadian tax on that income, that $50,000, which is $10,000, the US tax on the withdrawal. And the way we calculated this is, let's assume you're under the age of 59 and a half and you do incur a 10% penalty on that withdrawal. So anybody that's under the age of 59 and a half in the US will incur a 10% penalty on any IRA withdrawal. So let's say that's 25% US tax. So your foreign tax credit is going to be the lesser of your Canadian tax or the US tax that you paid. Now, the lesser is the Canadian tax that you paid already on that IRA distribution. So there's your foreign tax credit of $10,000. And you can see here very clearly that the foreign tax credit maximum is $10,000 and you've paid $12,500 to the US government. Therefore, you have $2,500 of unrecovered US tax. Now, that's only in cases where there's a penalty. You likely will recover that amount if you don't have a penalty. So if we just drop this amount here to 15%, then it's fine because the lesser of the 10,000 and the 7,500 is 7,500. You'll pay an extra amount of Canadian tax, but that's your rate anyways. In most cases, we want to kind of equalize this. You would hope something like this is at like 15%, but then you haven't paid an extra amount to the US. When you walk through this, you really want to make sure that you know that you're going to either pay a penalty or not pay a penalty and what your rate is. And once again, this is why transferring these plans to a Canadian RRSP often doesn't make sense because of the complexity involved and then the advantages you get once it's in the RRSP. We'll talk about this later, but just having the IRAs managed in Canada is much simpler than going through this whole process of getting it transferred to your RRSP. Now, once again, you do need to have a cross-border investment firm to help. Most Canadian firms cannot manage US IRAs. And this is the reason why you see this advice being given all the time from Canadian investment managers, where they'd be like, transfer your US IRA to an RRSP. In a lot of cases, that doesn't make sense for clients. It's not the best option for clients, but they don't have any other options other than to transfer the US IRA into an RRSP. If not, they can't manage the account. So that's probably the criticism that I probably give the most on some of this advice is, does that make sense for the client? For small accounts, sure, maybe that does make sense, but you have a $500,000 IRA, which we'll talk about next. It certainly does not make sense to walk through all that complexity to do the returns, to do the calculations for the FTCs, if we can just manage the account as is in Canada. Okay, so let's go back to the calculations for the US transfer. Okay, so that was a $50,000 transfer. Let's assume that we do a transfer of $500,000. So let's go to the same figures with a $500,000 transfer for US IRA to Canada. Now, the way the foreign tax credits calculation works is you can't really recover any tax on the US IRA unless you have Canadian source income and additional Canadian tax. So if you tried to transfer this $500,000 US IRA into your RRSP, it would take 10 years. And we won't walk through the calculation like we did before, but essentially same thing, 50,000 versus 500,000. Unless you have $500,000 of Canadian source income, which most don't in their retirement years, then you wouldn't be able to transfer that in unless you took 10 years to do it, which means every year you have to do those calculations. Every year you might have to contend with CRA on these foreign tax credit calculations. It just doesn't make sense to do this or put a client through this unless absolutely necessary. And that's why very important to get a cross-border investment firm to help with this, because they can just hold the US IRA, manage it with the rest of the accounts without dealing with any of this complexity. Okay, so let's go back to our examples. So we went through the first example, 50,000, the $500,000 example. Okay, so now if we're assuming here that the transfer to the Canadian RRSP likely doesn't make sense for most people, especially if you have a sizable US IRA, what should you do with your IRA then? Now, Likely, given the options for transferring these into Canadian plans, doesn't make sense for most people unless you have small accounts, obviously. Moving the account up in kind, which means that it would be managed by a Canadian cross-border investment firm, but be custodianed in the US. So we have a US custodian that we use, we have a Canadian custodian that we use where our clients' assets are held. But that means that all the accounts then are managed directly from Canada in a very holistic approach, right? So you're not having an advisor down in the US do some work and planning for you, and then somebody in Canada. Everything gets managed together in one place. That integration and planning, especially when you're combining cross-border investment planning and cross-border tax planning, is really, really important. I mean, we've seen this and we talk about this all the time. The amount of unnecessary errors and complications and complexities within tax returns and planning that are completely avoidable if you spend the time to plan and look at all your investments in your tax situation together. The other huge advantage here that we didn't talk about a ton, the ability to defer these US plans compared to, let's say, Canadian plans. So just to give kind of an overview here, Canadian plans, so we're talking about Canadian RRSPs and Canadian RRIFs, retirement income funds. So once your RRSP converts to a RRIF, when you pass away, you can designate a beneficiary, a spousal beneficiary, and he or she can hold that account, and that transfer happens tax-free upon death. However, once the second spouse passes away, that Canadian plan will be fully taxable in the year of death. So you can't, you're not going to be able to further defer that plan to a non-spousal beneficiary. Now, that's very different than U.S. plans in that U.S. IRAs can have listed beneficiaries, non-spousal beneficiaries, and you can continue deferring for 10 years, which is huge. And when you're talking about the kind of power of compounding deferred accounts, that's massive. So over 10 years, you can continue to defer the account. Now, you do have to withdraw the funds from the account within 10 years, but you get that additional 10 years, which you wouldn't with Canadian RRSP. So if you transfer your US IRA to a Canadian RRSP, you've essentially lost that tax advantage of deferral, which is, absolutely huge. And of course, we talked about listed beneficiaries. If you don't have listed beneficiaries on your US IRAs and you pass away, that amount gets paid to your estate and be fully taxable. That's a huge mistake. We see this, all the time. It's one of the things we check for clients initially when we're helping manage their US IRAs to make sure they have beneficiaries on the account. Once again, if that gets missed, there's not much you can do. Once it gets distributed from the estate, then there's absolutely nothing you can do. I remember, and I'll share this story, and this story I tell a lot. I remember a few years ago, we had a client when I was at the tax firm, got some really bad advice from somebody and withdrew $400,000 from their US IRA, and they had the check in the office. And we managed to have them not cash the check and then communicate with, I think they were with Fidelity at that point, to make sure that deregistration didn't happen. Because if that deregistration did happen, they'd be fully taxable on the $400K. We kept it in the US IRA, and they end up not having to pay, tax on $400,000, which would be significant. And you would likely be over 40% tax, especially if they had other Canadian source income. So huge win, but just, a story to kind of, underline here how important it is to do this planning and not be deregistering funds from a US IRA for no reason other than to have somebody manage it in Canada. Okay, so just to kind of walk through what we talked about today. In some cases, if you do have a small IRA, that might make sense to transfer it to Canadian RRSP. If it's larger and you might not have a significant amount of Canadian source income, that could take many, many years. And remember, the complexity involved in doing that with potential CRA reviews, FTC calculations can be a real pain to clients, and we want to minimize the friction and pain that our clients feel with respect to tax. Obviously, we want to find somebody in Canada to help. We help hundreds of clients with their cross-border investments. Once again, reach out if you need help. Phil at beaconhillwm.ca. And just outline your situation. If we can't help, we'll find somebody to help. We get lots of emails every week, and we really do try to get back to everybody to at least give them an idea of their situation, and then find a professional to help. That integration into planning is really, really important. Having your accounts spread all over the place, managed by different individuals, is definitely not the most efficient way to handle accounts, and especially when you're talking about tax planning. We talked about the continued deferral of IRA plans compared to RRSPs. That's huge. 10 years of deferral, especially for large accounts, is tens of thousands of dollars in unnecessary tax, essentially. And then, of course, beneficiaries, very, very important. Include beneficiaries on your US IRAs. If not, there's a potential for it to get paid out to the estate once you pass away, and that's fully taxable, which could be devastating from a tax perspective. So once again, if anybody has any questions on any cross-border tax or investment issues that they're facing, please feel free to reach out. Great place to check out what we have to offer, and then lots of articles on the blog. Beacon Hill, WM.ca. My email is below. another great resource for the group. We have a dedicated YouTube page with podcasts on cross-border tax and investment topics, and our great Americans in Canada Facebook page. And what we can do now, we'll just hop over here. Can show. So here is our Americans in Canada Facebook group. Now, the Facebook group is closed, so you have to be admitted to the group community. And the reason it's closed is we have requests from our community that, a lot of this information be kind of behind a private group, because some of this, some of the questions that people ask would be quite confidential, although you can contribute as an anonymous member. So if you want to ask a question like this individual, you can without showing your name to the group. So great community, lots of questions, lots of great answers, lots of great support from our community. It takes a lot of effort to moderate this because we have lots of nefarious individuals trying to enter the group, but I try to keep it as well moderated as possible. And once again, just very supportive group, and it continues to grow week over week, almost at 10,000 members, which is great. And then the other place to visit would be, you want to probably check out our YouTube page. If you're not already subscribed to our podcast, lots of great videos here. And, I've recorded quite a few in the last week, so there'll be many more up. Hopefully be doing some interviews in the near future with some great tax and investment professionals, even some immigration attorneys. So if you haven't subscribed already to Crossing the 49th podcast, easy way to do that on the YouTube channel. And there'll be links below to Apple Podcasts and the Spotify subscription. And with that, I think that's likely a good place to end. Once again, big thanks to everybody for their support. Thanks again to the great Facebook community. If you have any questions, all the contact info is below. Please feel free to reach out. Thanks for watching, and we'll see you on the next one.